Before apps and spreadsheets, families and shopkeepers used pencil and paper money moves that still work. Business manuals from 1900 to 1930 taught secrets richer than Wall Street today. We'll uncover 30 forgotten tricks, and the very last one will blow your mind. 30. Head math with the rule of 72. A simple trick. Divide 72 by the interest rate to estimate how long money takes to double. At 6%, savings doubles in about 12 years. Bankers used it daily for mental math, no calculator needed. Today, it's still perfect for quick checks on investments, retirement growth, or credit card debt traps. 29. Sinking funds for known bills. Instead of scrambling for taxes or insurance, families built sinking funds, small daily or weekly savings, toward big annual costs. Just a dime a day added up to insurance premiums by year's end. The method reduced stress and avoided debt. Modern analog, automatic savings transfers for car repairs, holidays, or property taxes. Discipline beats surprise every time. 28. The 3-column cash book with a weekly close, shops and homes, used a simple cash book with 3 columns: money in, money out, and balance. Every Saturday, they closed the book to catch errors and keep spending honest. This tiny ritual prevented overdrafts long before banks offered alerts. Today, it's the same as a weekly budget review or reconciling with an app like Mint. 27. The 2% off net 30 discount calculation. Suppliers often offered 2% off if paid in 10 days instead of the full bill in 30. Smart merchants did the math. Skipping that discount equaled borrowing at 36% annual interest. Paying early saved fortunes. The principle remains in credit card interest versus paying balances in full. Tiny percentages add up to massive costs. 26. Keystone pricing retail stores long used the Keystone rule. Double wholesale cost to set the selling price. Buy for $10, sell for $20. It covered overhead and profit in one easy formula. While margins vary today, Keystone remains common in apparel, jewelry, and niche retail. It's a reminder that simple math often beats complex pricing models. 25. Margin versus markup clarity. Old business manuals drilled this difference hard. Markup is profit on cost. Margin is profit on selling price. Mark up a $50 coat by 50%, and you sell it for $75, but the margin is only 33%. Confusing these numbers led to bankrupt shops. Even today, managers mix them up, proving this boring math still decides whether a business sinks or swims. 24. Break-even chart basics. Small shops once sketched break-even charts by hand. Fixed costs, variable costs, and sales lines crossing where profit finally began. It gave owners clarity, knowing exactly how many units to sell before a penny of profit arrived. A bakery might need 3,000 loaves per month just to cover rent and wages. Today, spreadsheets automate it, but the core insight remains vital. 23. Inventory cards and turnover targets. Before barcodes and ERP software, shopkeepers tracked stock with handwritten cards. Each item's purchases, sales, and balances noted daily. Turnover goals were simple. Sell out fast enough that cash wasn't trapped on dusty shelves. If shoes sat longer than 90 days, alarms rang. Today, the same principle fuels just-in-time systems, proving controlling inventory is the heartbeat of profit and survival. 22nd, tickler file for bills and receivables. A wooden or cardboard tickler file saved countless businesses. Bills, invoices, and customer promises were sorted by day of the month. Each morning, pull today's folder and act. No deadlines missed, no receivable forgotten. It was the analog reminder system that kept credit flowing. Modern parallel? Calendar alerts, project boards, or automated bill pay. The logic hasn't changed. Organized follow-ups beat chaos. 21. T accounts to spot leaks. Clerks and families alike used simple T accounts, debits on the left, credits on the right, to watch money's path. When cash vanished mysteriously, the T exposed leaks. Too much on tobacco, too little collected from customers. These scratch paper audits turned mysteries into patterns. Even today, sketching a quick T account can reveal why "I'm broke" is often bad habits, not bad luck. 20. Dunning letter scripts for collections. Merchants once relied on scripted letters to collect overdue bills. The first was polite, the second firmer, and the third demanded payment. This system kept relationships intact while securing cash flow. In the 1930s, collection manuals even offered exact wording. Today, automated emails follow the same sequence, proving structured persistence still outperforms random pleading when chasing receivables. 19. The household envelope system cash was divided into envelopes labeled rent, food, clothing, and emergencies. Once an envelope emptied, spending stopped. No borrowing, no exceptions. Families swore by this system in the 1920s and 30s when banks offered little consumer credit. It was budgeting discipline you could hold in your hands. Today's digital equivalent is YNAB, or banking pockets, but the psychology is identical. 18. The 50-30-20 guidelines ancestor. Early manuals suggested a crude but effective split. 1/3 of income for food, 1/3 for housing, and 1/3 for everything else. It wasn't elegant math, but it kept families balanced when wages were slim. Unlike today's flexible budgets, these rules anchored households through the Great Depression. Modern 50-30-20 budgeting echoes the same principle. Structure creates freedom by preventing runaway spending. 17. Ledger balance versus bank balance reconciliation. Families once wrote every check, deposit, and withdrawal into ledgers, then matched them with monthly bank passbooks. Errors and forgotten checks surfaced quickly. In the 1920s, bank manuals warned that failing to reconcile meant overdraft chaos. The practice still matters. Today's apps automate it, but people who skip reconciliation discover bounced payments, hidden fees, and unpleasant surprises the old-timers knew to avoid. 16. Rainy day contingent account. Farm and household finance guides urged families to keep a contingent account, a stash for illness, crop failure, or broken wagons. Even small sums like 50 cents a week built cushions against disaster. During the 1930s, these reserves often meant survival through drought years. Today, we call it an emergency fund, but the principle hasn't changed. Future-proofing is the quiet secret of stability. 15. Weekly closeout habit. Shopkeepers and families alike shut their books every Saturday night. Totals were added, errors corrected, and the week's results discussed. This rhythm kept businesses alert long before software dashboards. In the 1920s, small grocers who closed out weekly survived downturns better than those who waited monthly. Today, weekly budget reviews echo the same rule. Frequency creates clarity. Clarity prevents collapse. 14. Percentage of sales planning. Business manuals urged owners to fix expenses like advertising or payroll at strict percentages of sales. A store might allow 10% for wages, 5% for ads, and so on. This method prevented overspending during flush weeks. By the 1930s, chain stores thrived on percentage discipline. Modern firms still budget this way, proving a century-old method keeps costs proportional to income. 13. Chain of 3 checks for payments. Larger firms avoided fraud with the 3-person rule. One clerk wrote the check, another signed, and a third posted it to the ledger. No single person controlled the whole transaction. In the 1920s, this reduced embezzlement cases significantly. Corporate finance departments still use dual authorization and segregation of duties, proving simple safeguards remain as effective as expensive compliance systems. 12. Pay yourself first. Old version farm families were told to set aside savings before buying anything else. A farmer might save $2 from a $20 crop sale before paying bills. Though the amounts were tiny, this habit built reserves even in lean years. Manuals stress that self-discipline mattered more than income level. Today's automatic paycheck deductions echo this wisdom. Priority savings beats leftover savings every time. 11. Cash discounts versus carrying costs. Old credit manuals calculated the real cost of skipping cash discounts. Refusing a 2% discount on a bill due in 10 days often equaled paying 30 to 40% annual interest if funds were borrowed instead. Merchants learned to pay early whenever possible. Today, the math still applies. Credit card interest can wipe out small discounts. Proving timeliness in payments creates invisible profit. 10. The balance sheet for households. Families once drew balance sheets at year's end, listing assets like livestock, tools, and savings against debts like mortgages or store credit. Even school manuals taught children to prepare them. In 1929, many realized too late that their net worth was negative. Today, apps calculate instantly, but the lesson remains. Knowing your household's true worth is the foundation of financial control. 9. Capital budgeting with a notebook. Farmers scribbled cost-benefit notes before buying tractors or building barns. If a $500 machine saved 200 hours of labor yearly, they compared savings to the debt cost. This was grassroots ROI long before spreadsheets. Many avoided ruin by skipping bad purchases. Modern startups run complex ROI analyses, yet the principle is identical. Write it down, check the math, avoid blind spending. 8. Gross versus net wage awareness. Business texts reminded workers their $20 weekly wage shrank once deductions hit. Social Security after 1935 deepened the lesson. Workers saw gross pay on one line and take home on another. Many families kept notebooks comparing promises versus reality. Confusion over gross versus net still exists today, especially for first-time workers. A paycheck's true value is not what's offered, but what arrives in hand. 7. Barter as budgeting. In rural America, eggs, butter, or even fence repairs often served as currency. A family could trade 10 dozen eggs for school books or flour. During the Depression, barter expanded when cash evaporated, with over 1/3 of rural transactions non-monetary. These trades required careful valuation, a primitive form of budgeting. Today, community swaps, barter networks, and gig exchanges echo the same resilience. 6. Calendarizing income streams. Household manuals taught families to map yearly income, harvests, rents, or seasonal wages against bills. Lining up known inflows with due dates prevented panic. For example, a farmer selling wheat in September would earmark part immediately for winter taxes. This foresight meant fewer defaults. Today, financial planners call it cash flow forecasting. But the wisdom is timeless. Timing matters as much as totals. 5. Fixed versus variable expense drills. Old accounting guides urged families to list expenses as fixed, rent, insurance, or variable, food, clothing. This clarity showed where cuts could be made fast. During the Depression, households learned that only about 40% of costs were truly fixed. The drill prevented overspending when wages fell. Today, the same classification drives budgeting apps and corporate finance, proving visibility is half the battle. 4. The profit-first mindset. Many shopkeepers skimmed a fixed percentage of every sale as profit before paying any expenses. If $10 came in, $1 was stashed aside immediately. This forced businesses to live within the remaining 90%. System magazine called it the merchant's insurance against drift. Modern small business books revived this exact model, showing once again that self-imposed scarcity builds survival and long-term wealth. 3. Rotating credit among neighbors. Farmers often pooled funds in small circles, lending to each member in rotation for tools, seeds, or emergencies. These informal money clubs kept communities afloat when banks refused loans. Anthropologists estimate such lending covered up to 15% of rural capital needs in the 1920s. Today, the system survives globally as microfinance or rotating savings groups, proving trust-based credit outlasts formal institutions. 2. Weekly allowance with a ledger. Parents gave children coins for chores, but required each cent to be written in a small notebook. Kids tracked candy purchases, church donations, or savings goals. By the 1930s, many schools encouraged thrift clubs, where students deposited pennies weekly. This trained financial literacy long before the term existed. Today, apps mimic the same lesson. Write it down, see the leaks, learn restraint. 1. The master lesson: discipline beats tools. Every manual, from farm account books to business barometers, repeated one truth: the habit mattered more than the system. Whether using a pencil, a ledger, or envelopes, consistent recording and review created wealth. Families who tracked faithfully survived depressions. Those who didn't vanished in debt. Today, apps make entry easy, but discipline remains the irreplaceable tool. No gadget can substitute grit. Thanks for watching. If these forgotten finance tricks amazed you, just imagine what else we've got in store. Hit like, share your thoughts in the comments, and subscribe for more hidden money secrets. Don't miss the next video. It's even better